There is a question that serious investors are asking privately that almost no one is asking publicly because the question itself carries an implication that is too uncomfortable for mainstream financial commentary to confront directly. The question is not whether the Federal Reserve will cut rates or hold them. It is not whether gold goes to 3,500 or pulls back to 2,800. It is not whether the next recession begins this quarter or next year. Those are important questions, but they are the wrong level of analysis for what is actually happening in the monetary system right now. The question that matters, the question that gold has already answered, that sovereign institutions have already answered with their reserve portfolios, and that the public has not yet been given the analytical framework to ask, is this: has the Federal Reserve already lost the thing that actually matters? Not the ability to set interest rates, not the ability to buy bonds or expand its balance sheet, but the deeper thing, the thing that all of those tools depend on to function, which is the credibility to make the global financial system believe that it can simultaneously manage inflation, prevent financial instability, and sustain the fiscal arithmetic of a nation carrying more debt than any peacetime government in the history of civilization. That question does not appear on any Fed dashboard. It does not have a ticker symbol. It cannot be captured in a dot plot or a press conference. But gold is capturing it. Gold has been capturing it for 2 years with a persistence and a sovereign buyer profile that removes any ambiguity about what the signal means if you know how to read it. Too late is the most psychologically powerful question in investing. It carries the weight of every prior moment when someone who understood a shift did not act, waited for more confirmation, waited for the consensus to form, and then watched the confirmation arrive at a price that had already incorporated the information they were waiting for. Too late is the fear that paralyzes rational action at exactly the moment when rational action is most available and most consequential. I want to answer that question honestly in this session, not with reassurance designed to make you feel better, with the structural analysis that actually determines whether the window is open, closing, or closed. Stay with me for the next 25 minutes because I am going to give you 3 things. First, the precise mechanism by which the Federal Reserve has lost grip, not on interest rates, which it still controls, but on the deeper levers of monetary credibility that determine whether its actions produce the outcomes it intends, or whether those actions increasingly produce the opposite. Second, the hidden monetary reset that gold is signaling, what it is not, how far along it is, and why the word hidden is accurate rather than conspiratorial. Because the most consequential financial shifts in history are always hidden in plain sight, visible in the data to those with the framework to read it and invisible to those without. Third, the answer to the too late question, honest, specific, grounded in historical precedent, and without the false comfort that makes for good short-form content but bad long-term positioning. I have spent decades watching monetary systems approach these thresholds, not in theory, not in academic models, but in the real-time behavior of sovereign institutions, currency markets, commodity prices, and the long-cycle patterns that repeat across different eras with different participants but identical underlying mechanics. What I'm watching now is the most clearly legible version of those patterns I have seen in my professional lifetime. The legibility itself is a signal. The question is what you do with it. Let us begin with the Federal Reserve's grip, because the loss of that grip is the central mechanism of everything else that follows, and it is not the story that is being told in financial media. The standard narrative about Fed credibility is binary. Either the Fed has it or it has lost it. Either markets believe the Fed can control inflation or they do not. Either the bond market trusts the institutional commitment to price stability, or it demands a premium for holding Treasury obligations that reflects skepticism about that commitment. That binary framing is too simple and therefore too easily dismissed. When the Fed raises rates and inflation eventually moderates, the binary framing allows the institution to claim vindication, to say the tools worked, the commitment was credible, the mission was accomplished, and in a narrow technical sense, that claim is defensible. Inflation from its 2022 peak did moderate. The policy rate did affect demand in rate-sensitive sectors of the economy. But here is what matters. The moderation of inflation from a peak does not restore the credibility that was damaged by the decade of policy that created the conditions for that inflation. It does not address the fiscal arithmetic that makes the inflation problem structural rather than cyclical. And it does not resolve the fundamental contradiction that now sits at the center of Federal Reserve policy, a contradiction that has no clean resolution and that every serious institutional observer of the monetary system has already identified and priced into their long-cycle positioning. The contradiction is this. The Federal Reserve's mandate is price stability and maximum employment. Its tools are interest rate adjustments and balance sheet management. Those tools function through a transmission mechanism that depends on the financial system remaining stable, on banks being solvent, on credit markets remaining open, on the government bond market functioning as the liquid foundation on which all other financial pricing rests. Now introduce the fiscal reality. The United States government is currently borrowing approximately $2 trillion per year to fund the gap between what it collects in taxes and what it spends. The interest cost on existing debt has crossed $1 trillion annually. The debt-to-GDP ratio has crossed 120% and is projected to continue rising under every baseline scenario that does not involve either dramatic spending cuts or substantial tax increases, both of which are politically unavailable in the current environment. In this fiscal environment, every percentage point of interest rate that the Federal Reserve maintains translates into additional hundreds of billions in annual interest expense for the Treasury. Keeping rates high to fight inflation accelerates the fiscal deterioration of the entity, whose debt the Fed is simultaneously expected to support as the risk-free benchmark of the global financial system. Cutting rates to relieve fiscal pressure risks reigniting inflation, which damages the credibility the Fed needs to anchor long-run inflation expectations, which causes bond investors to demand higher yields as compensation for inflation uncertainty, which increases the fiscal pressure it was trying to relieve. This is not a policy puzzle with a clever solution. This is a structural trap, and the Federal Reserve did not create it. Decades of fiscal choices created it, but the Federal Reserve is now operating inside it, and the tools it has were designed for a world where this trap did not exist. Write this down. An institution loses grip not when it loses the technical ability to execute its policy tools. It loses grip when the execution of those tools consistently produces outcomes that diverge from their intended effects. When rate increases designed to reduce inflation simultaneously increase the fiscal deficit that is itself inflationary. When rate cuts designed to stimulate growth simultaneously signal credibility erosion that causes the currency to weaken and import prices to rise. When the tool produces the problem it was designed to solve, the grip on the system is broken at the level that matters. This is the part most people miss. The Federal Reserve's loss of grip is not visible in any single policy failure. It is visible in the progressive impossibility of achieving all of its stated objectives simultaneously in the fiscal environment that now exists. The grip was not lost in a moment. It was lost across a decade of interventions that were each individually rational and collectively self-undermining. Gold has been measuring this loss of grip in real time, and the measurement has been precise. Now let me describe the hidden monetary reset, what it is, why it is hidden, how far along it is, and why the combination of those three answers is the most important information any serious investor can hold right now. A monetary reset, in the historical sense, is not a single event. I have said this before, and I will continue to say it because the single event misconception is the primary reason people misread the timing and the nature of what is happening. A monetary reset is a structural transition, a period during which the rules of the existing monetary order are progressively replaced by a different set of rules through the accumulated force of sovereign decisions, institutional adaptations, and market pricings that each individually look manageable and collectively constitute an irreversible change. It is hidden for a specific reason. The institutions that are implementing the reset, the central banks that are accumulating gold, the sovereign wealth funds that are diversifying away from dollar assets, the oil producers that are establishing yuan settlement pathways, the BRICS nations that are investing in alternative financial infrastructure, are not announcing their intentions publicly because to do so would be to accelerate the very destabilization they are trying to navigate around. A central bank does not hold a press conference to announce that it has lost confidence in the dollar system. It quietly adds gold to its reserve portfolio quarter after quarter without fanfare and without explanation. And the cumulative effect of those quiet additions is what the World Gold Council reports months later to the narrow audience that reads commodity reserve data carefully. The reset is hidden in plain sight. The data is public. The direction is unambiguous. The institutional logic is coherent and well documented for anyone willing to engage with it at the necessary depth. What makes it hidden is not the secrecy of the participants, but the inadequacy of the framework through which most observers interpret the data. Here's what matters. The hidden monetary reset is not a plan. It is an emergent process, the outcome of dozens of independent sovereign decisions, each made in response to the same structural reality, that are collectively producing a directional shift in the global monetary architecture without any single institution directing the outcome. This is how all major monetary transitions have occurred historically. The Bretton Woods system did not end because someone decided to end it. It ended because the structural conditions that had sustained it, American balance of payment surpluses, dollar scarcity, the credibility of gold convertibility, had been progressively eroded by a decade of fiscal and monetary decisions until the system was operating on institutional inertia alone. And Nixon's announcement was the formal recognition of a reality that the market had been pricing for years. We are in the equivalent phase now. The structural conditions that have sustained dollar primacy, the petrodollar recycling loop, the absence of credible alternatives, the political alignment of major oil producers with the American security architecture, the fiscal discipline that the reserve currency function requires, densi norms, densi onesi have thus been progressively eroded. The system is operating on institutional inertia and the absence of a fully formed alternative. The reset is underway. It does not have an announcement date. But it has a direction and it has a pace, and both are clearly legible in the data. Let me be precise about how far along it is. The dollar's share of global foreign exchange reserves has declined from approximately 71% in 2000 to somewhere below 60% today, depending on the measurement methodology. That decline has not been linear. It has been gradual, then accelerated. Central bank gold holdings as a percentage of total reserves have been rising from a multi-decade low, with the rate of increase accelerating after 2022. The percentage of global trade settled in currencies other than the dollar has been rising, with the most significant increases occurring in bilateral commodity trade between major emerging market economies. Alternative payment infrastructure, UN clearing systems, BRICS payment initiatives, bilateral clearing arrangements, has moved from conceptual to operational across multiple corridors. None of these individually is decisive. Together they define a direction, and the direction has been consistent for long enough and across enough independent institutional participants that characterizing it as temporary or cyclical requires a level of motivated reasoning that is increasingly difficult to sustain. The reset is approximately a decade into a process that will take another decade or two to complete. That is the honest answer about where we are. Early enough that the positioning opportunity remains meaningful. Late enough that the direction is no longer speculative. Now watch what happens next, because this brings us directly to the question that is the title of this entire session. Before we go there, if you are finding value in this level of structural analysis, if this is the framework you have been looking for that goes beneath the daily noise and into the actual mechanics of what is moving these markets and these systems, subscribe now. This work is built for exactly the kind of thinking you are demonstrating by being here. Too late. I want to approach this question with the seriousness it deserves because it is not a trivial question. It is the question that determines whether the analysis I have laid out in this session leads to useful action or to paralysis. And the honest answer has several components. The first component is historical. In every prior reserve currency transition, the window between institutional recognition and public recognition has been long. Not infinitely long, but substantially longer than most retail investors' conception of market timing would suggest. When sterling began its structural decline in the aftermath of the First World War, There were still decades during which the positioning choice between sterling assets and alternatives was meaningful and actionable. The investors who acted in the 1920s captured the full transition. The investors who acted in the 1930s during the Depression-era crises that made the sterling problem undeniable captured most of it. The investors who waited for Bretton Woods in 1944 to formalize the dollar's primacy before acknowledging that sterling's era was over captured almost none of it. We are earlier in the dollar transition than Bretton Woods was in the sterling transition. We are in the phase that corresponds roughly to the late 1920s or early 1930s equivalent. The phase when the structural problems are visible and documented and increasingly consequential but not yet resolved into the formal institutional moment that the history books will eventually call the transition point. That means the positioning window, while not unlimited, is not closed. The second component is asset-specific. The too late question has different answers depending on what asset you are evaluating. For certain dollar-denominated financial assets, long-duration treasury bonds, for example, in a world where the structural demand for those bonds is declining and the supply is increasing, the too late question has a different valence than it does for gold. For gold, the too late question must be evaluated against the buyer profile that is driving the price and the structural momentum behind that buyer profile. Central bank buying, as I have described, is not driven by price sensitivity in the way retail buying is. A central bank that made the analytical judgment to add gold to its reserve portfolio at $2,000 per ounce does not reverse that judgment when the price reaches $3,000. The judgment was about the structural composition of the reserve portfolio over a multi-year time horizon, not about the price of gold in a specific quarter. The continuation of sovereign buying at elevated prices is not a sign of irrationality. It is a sign that the institutional logic behind the buying is structural rather than tactical, and that structure has not changed. Let me be precise about the implications. When the marginal buyer of an asset is a central bank with a structural, time horizon independent mandate to hold that asset as a reserve instrument, the price sensitivity that governs retail timing decisions does not apply in the same way. The buying does not stop because the price is higher than it was 2 years ago. It stops when the structural conditions that motivated the buying have changed. Those conditions, the fiscal arithmetic of the dollar system, the petrodollar erosion, the geopolitical fractures that have made sovereign institutions reassess their dollar exposure, have not changed. They have intensified. The third component of the too late question is the most psychologically important, and it is the one that most people avoid because it requires a level of intellectual honesty that is uncomfortable. Too late relative to what? Too late to buy gold at $2,000? Yes, obviously. That price is gone. Too late to participate in the structural revaluation of gold as the hidden monetary reset progresses from its current stage to its middle stage and eventually to its completion. The historical record of prior transitions says no, emphatically no, because the middle stages of reserve currency transitions are precisely when the price acceleration is most sustained and when the gap between early and late positioning, while still real, is less catastrophic than the gap between positioned and unpositioned. The risk of being too late is real. It exists. It is not a made-up concern, but the risk of acting on the fear of being too late by doing nothing is larger because the structural forces in motion are not going to stop moving while you decide whether you have missed the window. They will continue to move. The reset will continue to progress. The sovereign buying will continue. The petrodollar recycling will continue to erode. The Federal Reserve will continue to operate in a structural trap that has no clean exit. And the public, which is always last, will continue to understand none of this until the price of understanding it has become substantially higher. Let us close by bringing the three threads into their final synthesis and giving you the clearest possible picture of what we are actually looking at. The Federal Reserve has lost grip not on its policy rate, which it still controls, but on the deeper mechanisms of monetary credibility, the ability to achieve all of its stated objectives simultaneously in an environment where the fiscal arithmetic has made those objectives structurally incompatible. That loss of grip is not visible in any single meeting, any single data print, any single policy failure. It is visible in the progressive divergence between what the institution's tools are designed to achieve and what they actually produce when deployed in a system that has exceeded the design tolerances those tools were built for. The hidden monetary reset is the structural process, a decade in progress, visible in the reserve data of 40-plus sovereign institutions, legible in the behavior of the petrodollar system, documented in the gold buying figures that most people read as a commodity story, and that are actually a sovereign judgment about the long-cycle direction of the monetary architecture, that gold is continuously reflecting in its price and its buyer profile. And the answer to the too late question is the answer that every careful student of monetary history has arrived at when evaluating the positioning window relative to a transition that is real, directional, structural, and still in progress. Too late for the first chapter, not too late for the chapters that remain. And far less late than you will be if you wait for the public recognition that always arrives after the most consequential portion of the transition has already been expressed in price. What unites all three threads is the recognition gap, the space between what the most informed institutions have priced and what the broadest market has understood. That gap is not infinite, but it is real, it is currently open, and the historical record is unambiguous about what it is meant to be inside it rather than outside it during the equivalent phases of every prior monetary transition the modern world has experienced. Gold is not signaling a crisis, it is signaling a reset. And there is a profound difference between those two things for how you think about time, about positioning, and about what constitutes a rational response to structural forces of this magnitude. A crisis passes. A reset does not pass. A reset resolves into a new equilibrium, a new set of rules, a new monetary architecture with new winners and new losers. And the distance between the winners and the losers in a monetary reset is not determined by who panicked most productively during the worst moment of the crisis. It is determined by who understood the structural direction of the transition early enough to position with it while that positioning was still available at a price that reflected incomplete rather than complete information. The reset is hidden only to those who have not been shown where to look. You have now been shown. What happens next with that knowledge is yours to decide.